So, what are the key differences between accounts payable and deferred revenue? Accounts payable represents amounts owed to suppliers, while deferred revenue represents amounts received from customers in advance of delivering goods or services. Diving deeper into the definitions, accounts payable refers to the amount a company owes to its suppliers or vendors for goods or services purchased on credit. It's a liability account that represents the amount the business needs to pay to its creditors. On the other hand, deferred revenue, also known as unearned revenue, represents the amount a company has received from customers in advance of delivering goods or services. It's a liability account that indicates the company's obligation to provide goods or services to its customers. And if we look at debits and credits, accounts payable is recorded as an increase or debit to inventory or expenses, and an increase or credit to accounts payable. When payment is made, it is recorded as a decrease or debit to accounts payable and a decrease or credit to cash. With deferred revenue, the picture is different. It starts with recording a cash receipt. It is recorded as an increase or debit to cash and an increase or credit to deferred revenue. When revenue is recognized, it is recorded as a decrease or debit to deferred revenue and an increase or credit to revenue. If you are not familiar with the rules of debit and credit, watch my video. I am posting the link here and in the description below. If you had any experiences with accounts payable and deferred revenue that you would like to share, or if you have any questions about these concepts, please leave a comment below. If you are interested in learning more about accounting and financial management, check out my videos on financial accounting tips and real-world examples to take your accounting skills to the next level. Thank you for watching, and I hope to see you all again in the next video.